Somewhere in Shanghai this week, a number misbehaved. It did not misbehave loudly. No bells, no red arrows flashing across a trading floor in some cinematic fashion. It simply broke a pattern that has held, without serious exception, for 4 decades. And if you know what to look for, that quiet malfunction tells you more about the real state of the silver market than every panicked headline COMEX has produced this month combined. Here is the rule it broke. Silver panic is supposed to originate in New York and arrive in China a step behind, cushioned by a premium built for exactly that purpose. That has been the working theory of 3 generations of metals traders, and like most theories that survive a long bull market untested, it was less a law of nature than a habit nobody had bothered to check. This week, somebody checked. Shanghai fell harder and faster than the West did. A sharper single-session decline in China than the roughly 2 to 3% slide logged in Western spot, which itself has been drifting in the high 50s, hovering not far from $58 to $59 an ounce, well off January's all-time nominal high above $121. The market that was supposed to be cushioned fell first. The bell rang in the wrong building. Stay with me, because there's a second fact sitting right next to the first one, and it is the fact almost nobody covering this story has bothered to isolate. Even after that unusually sharp Shanghai session, the premium Chinese buyers pay over Western prices did not collapse. It is still sitting in the high single digits to low double digits, roughly 8 to 12%, depending on the exact fixing you check, essentially where it has been running for weeks. If Chinese confidence in silver as a physical asset were genuinely cracking, that premium, the very portion of the price that exists because Chinese demand is willing to pay more than the rest of the world for the same ounce, ought to have been the first thing to give. It didn't give. And that contradiction is the whole story. There is a particular kind of intellectual habit, one Edmund Burke spent a career defending, that involves trusting an inherited pattern simply because it has worked for a long time, even when nobody currently alive can fully explain why. 3 generations of silver traders inherited exactly such a habit about how Shanghai and New York relate to one another. This week, reality declined to cooperate with the habit. And when reality and inherited wisdom part ways, the interesting question is never which one is more comfortable, it's which one is telling the truth. 4 things are converging in the days around this moment, and together they explain why a 40-year pattern chose this particular week to crack. There is a genuinely hawkish new Federal Reserve Chairman, Kevin Warsh, finding his footing after running his first meeting in mid-June, a man who has already discarded the dot plot format markets leaned on since 2012, a small bureaucratic act with outsized psychological consequences, not unlike a new pope quietly declining the traditional shoes. There is a ceasefire over the Strait of Hormuz between the United States and Iran that has, for now, held long enough to allow renewed talks in Doha, though nobody serious is calling it settled. There is a June jobs report landing today, a report that in its previous outing, May's number came in at 172,000, well above what forecasters expected. Moved this entire metals complex within hours of release. And there is that premium in Shanghai, refusing to close, contradicting the simplest story anyone wants to tell about what happened this week. Warsh's tone has done real work here. The committee he now leads was, by most honest readings of the available projections, closer to a genuine split than the clean hawkish mandate the first wave of headlines implied. But markets, like most readers of newspapers, tend to act on the headline and revise their opinion of the footnote only later, if at all. The headline that stuck was simple. Rate cuts are off the table, and the market is now pricing meaningful odds of a hike as soon as September. That alone is enough to hammer an asset like silver, which pays no yield and has nowhere pleasant to hide when the cost of holding cash starts climbing. Layer the inflation picture on top of that, and the architecture sharpens. The same tension around the Strait of Hormuz that pushed energy prices higher earlier this year is the same tension that has kept headline inflation uncomfortably firm, which is the same firmness giving a new and largely untested Fed chairman institutional cover to keep tightening, which is the same tightening now crushing an asset that has spent much of this year as a favored inflation hedge. It is one chain, link to link, and this week's Shanghai-led decline sits at the very end of it, which is precisely why the part of the story still to come matters more than the headline number does. Henry Adams once observed that practical politics consists largely in ignoring inconvenient facts. Markets, mercifully, don't have that luxury. Their facts arrive daily, denominated in dollars and yuan, indifferent to whichever theory of the world they happen to be inconveniencing, so let's not ignore them. Let's ask the only question worth asking when a 40-year pattern breaks in a single session. Why did it break in that order? And why, despite the break, did the one number that actually measures Chinese physical appetite refuse to move? The honest answer requires understanding something structural about how the Shanghai Gold Exchange functions that is genuinely different from how COMEX functions. And the difference is not decoration, it is the whole mechanism, and it is where we're headed next. Start with the plainest structural fact in this entire story because it explains everything else. COMEX in the main is a paper market. The overwhelming share of its volume gets rolled forward or closed out in cash, with no bar of metal ever changing hands. The Shanghai Gold Exchange was built on the opposite premise, physical delivery, which means that when Chinese industrial buyers, solar manufacturers, electronics producers, and increasingly state-aligned accumulators take a position, a meaningful share of that activity ends with real metal entering a real vault. That single structural fact makes the Shanghai price more sensitive, not less, to the sentiment of people who actually need the metal to build something, rather than people merely betting on a chart. When macro pressure builds the way it has this week, a hawkish Fed, stubborn inflation, a ceasefire that could unravel by dinner, industrial buyers are often the first to hesitate. They pull back on near-term purchasing while they wait to see how the diplomacy resolves. That hesitation alone can move a delivery-based benchmark faster than it moves a paper one, where speculative positioning takes a session or two longer to fully reprice through futures rolls and margin calls. Shanghai didn't crack because Chinese demand evaporated. It cracked because the people who use silver to build things are, for the moment, waiting, and waiting buyers move a physical market faster than waiting speculators move a paper one. Consider, too, what's actually on the calendar, because the timing here has been doing more work than most coverage has credited. The ceasefire itself is fragile. Washington and Tehran have agreed to halt hostilities around the strait and resume negotiations in Doha, but fragile is the operative word, and markets, as a rule, fear genuine uncertainty rather more than they fear bad news that has already arrived and been priced. Chairman Warsh has upcoming public remarks that traders will parse line by line for any softening or hardening of his June tone. And today's jobs report, the June print, lands with the power to either validate or undercut the entire hawkish narrative within hours of its release, exactly as May's number did. 3 catalysts compressed into a very short window. This week's Shanghai-led decline may simply be Asian institutions de-risking ahead of any one of the 3 going wrong, none of which fully explains the detail that should genuinely surprise you. Despite falling faster than COMEX, Shanghai's premium didn't close. It's still sitting in that high single-digit to low double-digit range, roughly where it's been running for weeks. If this were truly a story about Chinese buyers losing confidence in silver as an asset, the premium ought to have compressed sharply, because a genuine loss of confidence strikes the premium first. It's the very slice of the price that exists purely because Chinese demand is willing to pay more than the rest of the world for the same ounce of metal. Instead, both benchmarks fell together in percentage terms, and the gap between them held. That is not the signature of collapsing demand. That is the signature of a market repricing against a global macro shock, while the physical tightness underneath it stays fully intact. And before we go further, if any of this has changed how you're thinking about what Chinese demand actually means versus what a headline price drop implies, that's exactly the kind of distinction worth having in your corner before the next one of these sessions happens, not after. This channel exists because enough people decided that kind of distinction was worth their time once already. It very nearly didn't get the chance to exist a second time. Rebuilding an audience from close to nothing after losing one that size is the sort of project most people quietly abandon, and I'll be honest with you. Some days it still feels like it could disappear again just as easily. If you want this kind of analysis delivered before it becomes a headline instead of 3 days after some press release reconstructs it badly, hit subscribe now while it's actually in front of you, because the algorithm will not remind you to come back. Now back to the mechanism, because there's a structural fact underneath all of this that neither a hawkish Fed chairman nor a fragile ceasefire can undo on any timetable convenient to a single news cycle. China's silver import licensing regime, tightened earlier this year, has not been loosened. The People's Bank of China has been adding to gold reserves for well over a year running, part of a broader pattern in which the overwhelming majority of central banks surveyed globally say they intend to keep adding to gold, not trim it. China's silver imports pushed to multi-year highs earlier this year, alongside a surge in gold imports. None of that demand infrastructure unwound overnight because a new Fed chairman scrapped a dot plot. The licensing restrictions are still there. The value-added tax structure on physical imports is still there. The logistical friction that keeps arbitrage from instantly closing the Shanghai COMEX gap is still there. What changed this week was the global price level both markets are repricing against, not the tightness underneath the Chinese physical market itself. That is why the premium held even as the absolute price fell faster in Shanghai than anywhere else. This connects to a deficit story that's easy to lose sight of during a sharp pullback and easy to overstate during a calm rally. Industry estimates have now pointed to several consecutive years of global silver supply deficits, with hundreds of millions of ounces drawn down from above-ground stockpiles over that stretch. A deficit of that character does not pause because the odds of a September hike moved a few percentage points. And it does not pause because Shanghai had one rough session. Solar manufacturers don't slow purchasing because of a single day's price drop. Their production schedules are built months in advance against government-mandated targets that answer to no central bank. The industrial engine underneath silver demand runs on a different clock than the monetary engine currently being hammered by this rate path. This week's price action belongs almost entirely to the monetary engine. The industrial one is still turning quietly underneath it, and what that means for where this goes next is where we're headed now. Fairness requires the other side of the ledger, because half a picture isn't analysis, it's marketing, and I didn't rebuild this channel to sell you marketing. If the current rate path plays out anywhere close to what the more hawkish forecasters are calling for, a federal funds rate pushing meaningfully higher by year-end would be a genuinely hostile environment for any asset that pays no yield, silver very much included. Some major banks have already trimmed their year-end targets for gold and silver alike, citing the wholesale removal of expected rate cuts from their forecasts. If gold keeps grinding lower under that pressure, silver's monetary engine gets dragged down with it, regardless of how tight the physical market in China remains. Today's jobs report is a real swing factor in exactly that fight. May's beat triggered a sharp sell-off across both metals within hours of release, and a repeat performance today would do the same trick twice. Against that sits a different camp, still holding meaningfully higher targets on the view that real upside remains once this rate hike repricing exhausts itself. Central bank demand for gold, the same demand structurally underpinning the Shanghai premium in silver, remains by most recent surveys near record levels of institutional conviction. And the gold-silver ratio, currently sitting somewhere in the high 60s, against a long-run average closer to the mid-60s, is precisely the kind of stretched reading that has historically preceded sharp silver outperformance, once rate hike fear finally peaks. This is a ratio that has swung from well over 100 during genuine panics to the mid-50s during friendlier stretches, which tells you how violently it can move once the macro winds shift even slightly in either direction. So watch four things closely over the days ahead. Because this window is unusually loaded, watch how the Doha talks actually resolve, since that alone could ease or reignite the energy-driven inflation feeding the hawkish narrative. Watch Chairman Warsh's next public remarks for any real softening, or hardening, of his June tone. Watch today's jobs number, where a soft print eases hike odds and a hot one extends the pressure, exactly as it did in May. And watch that Shanghai premium itself, specifically. As long as it holds near current levels even through further price weakness, the structural demand thesis stays intact. If you start seeing it genuinely compress, not merely hold steady through one bad session, but shrink meaningfully over a sustained stretch, that would be the real signal that Chinese physical demand is finally cracking. And it would be a far more serious development than anything in this week's session. Markets, like most of the institutions George Will has spent a career examining, run on two clocks that rarely agree with each other. There is the monetary clock, Fed meetings, jobs reports, ceasefire headlines, running loud and fast right now, hawkish and genuinely capable of pushing silver lower if the data keeps coming in hot. And there is the physical clock, solar installations, electric vehicle production lines, a multi-year run of global deficit that does not care in the slightest what happened in Doha this week. The monetary clock won this week's session and won it faster in Shanghai than in New York. But the physical clock is still running underneath it, and a premium that refuses to close is the proof of the running, even in a week when almost nobody was watching the gears. If this changed how you read this week's number, if the gap between what the headline said and what the premium actually did landed the way it landed for me when I first noticed it, tell me. Drop a comment with the one data point in this breakdown that surprised you most, the Shanghai premium holding, the structural deficit, the gold-silver ratio, whichever one it was. I read every single one because the whole reason this channel exists again after very nearly not existing at all is the people willing to say what actually made them stop and think. That's not a formality. That's the entire audience this was rebuilt for, and I'd like to know I got it right. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.